I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi and welcome. In this video we're going to take a look at how we really invest and how easy you can actually invest if you put your mind to it. I will be going through how we can relatively simple invest and get some outside return, and how to find these companies that make these gains possible, and then a little about when to invest in these companies, because that actually matters too. And my final one is going to be the biggest mistakes I made, and also what Peter Lynch said. He also had the same ways that I did. So let's get into it. I really like Peter Lynch and the way he thinks, his mindset, the way he goes about investing, and the idea he has that you don't need to know a whole lot. You just need to pay attention and do a little bit of research. I mean, he once made a joke, and actually it was a joke to begin with, that you could get by with a 5th grade education and become a great investor. And I don't remember exactly who did it, but a school teacher took him up on it.
She read the book, and I said, if you made it through 5th grade math, you can do it in the stock market. She says, okay. She started teaching it in 7th grade, right. 7th grade class. These kids had to study companies. Right. They had to look at their balance sheets to see if they're solvent. Yeah. And they picked stocks. These stocks were up 69% over 2 years when the market was up only 20.
So maybe Peter Lynch is right. You don't need to be a rocket scientist or a high education person. You can actually do very, very well with just the basic knowledge. And that's what this video is about. I'm going to try to show you that you can actually get great investments just by looking around your surroundings, your local community, or just what's going on in the world. And the fun part here, and that's actually the point of this video, is you don't have to pick all the right stocks. I mean, you can do very, very well if you just find one good stock. I will come with an example later where I found 10 companies and I put the same amount in each of them for 10 years. I know this is a hypothetical, but I actually did that back then. But just to show you how you could actually do it, let's say 60% or 50% of the stocks were real clunkers and went to almost zero, you could still beat the market. But we're going to go back to that example later. Okay, I assume you made the decision to invest and you understand how this is done. And this is not a casino or a lottery. These are actual companies, and that's a company you look at. And if the company performs well, it will eventually show in the stock.
Well, I think anybody that's investing in the stock market has to understand, you buy a company. These are not lottery tickets. These behind every stock there's a company. If the company does well, over time the stocks do well, and vice versa. You have to look at the company. That's what you're researching. That's what we do at Valley. That's what I do. The point is, when you say to yourself, do I need this money in a year? Do I need this money in 2 years? Do I need this money in 3 years? So my longer term stock market's been the best place to be last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks. You should be in a money market fund.
And now it's time to do better than just buying the S&P or the MSCI World Index. Now we want to make some real gains. I'm talking 25 to 30% a year. So our goal must be to outperform at least the S&P 500 over time. And at present it's lying around 11%. I'm guessing it's going to be a lot lower in the future, but let's go with those 10-11% for now. A fun fact, Warren Buffett's Berkshire Hathaway is running around 15% compounded annual growth in the period from 1985 till now, the same we were measuring the S&P for. We could go for the large caps where growth is probably okay and will result in nice returns, but I don't think it's going to be near enough if we want those high returns. We want those elusive 29% Peter Lynch achieved when he ran the Magellan Fund at Fidelity. So now we need to engage our brains and do a little work ourselves. So, what did I do? And what could you have done? And what should you do in the future? Let's say I found some great companies. I believed that they would do well in the next 10 years at least. And as it always goes, they don't all work out. But does this actually matter? Well, this example that I've chosen is going to show you no, it doesn't really matter that much, as long as you keep an eye on your companies. To make it more realistic, I actually took my own 10 companies that I invested in and the performance up until now. Now, it has to be said that I really didn't keep them for 10 years. I kind of sold them off and bought something else and went in and out just the way you shouldn't have done. But hey, there's always a better company somewhere, so my portfolio looks a little bit different today. And please note that the amount is not important. The only thing that's important is that you divide your, let's say, 10,000 or 100,000 equally among the stocks. Some of these companies are what I would call no-brainers, and others were what I thought was good back then. So, number 1, Apple, ticker symbol AAPL. In the 10 years from 2011 till now, Apple stock has had a compound annual growth rate of 28%. That's pretty damn good. Microsoft, ticker symbol MSFT, compounded annual growth 27%. Also great company. Intel, yeah, back then I thought Intel was great. Ticker symbol ENTC, compounded annual growth 12%. Cisco, ticker symbol CSCO. Great company, at least I thought so, but not as great as some other companies. But compound annual growth of 13%, not bad. Boeing, ticker symbol BA. Yeah, I know what you're gonna say, and they had their troubles and they paid for it, but still compound annual growth of 14%. Coca-Cola, yes, the good old Coke. Ticker symbol KO. Compound annual growth of 8%. And actually, I don't remember what the last stocks were, or 2 of them would have gone halved in value, and 2 of them would have gone bankrupt. And even with this lousy stocks at the bottom, 2 going bankrupt and 2 losing half their value, I still did very well. Over a 10-year period, all of these stocks, this portfolio, returned 316% in gains. That's a compound annual growth of almost 16%. And when the S&P returns around 10 to 11 at that same period, I would have had $100,000 more if I put those collectively 100,000 in. And still, that's with 2 going to 0, 2 losing 50%, and 4 doing just okay, just slightly outperforming the S&P, and 2 really good stocks out of 10, or should I say companies. And this kind of proves you only need to find 1 or 2 really good companies who will perform great in at least 5 to 10 years, and you will do very, very well. But okay, I'm not stupid. I would probably, or actually I did, use Peter Lynch advice somewhere along the way and cut the losers. Let's just say when they lost 50% of their value in a normal market, that shouldn't happen. So let's do the same example, just this time we invest the remaining from those losing stocks, the last 4, and we just invest them in the S&P 500. Then it would look like this. 466,000 in final balance. That's around 150,000 more than if I had put it all in the S&P 500. And now it's at 366% gains in 10 years. But hey, what if we picked companies just as well as Peter Lynch and quickly sold the losers or the non-performers? Did our research really well at an early stage, just like he did? We could have seen some of these great companies before they got really big and invested in them. All it takes is conviction and research. Like Amazon, Microsoft, Facebook. And note, these are not the companies with the largest growth in the last 10 years, but they did very well, and you could have seen these come. You would have known it if you researched right. If I took the same amount of money and put in only these 3 stocks, I would have made 1,459,000 out of the original 100,000. That's crazy. If we compare that to the S&P 500 or maybe Warren Buffett's Berkshire Hathaway, it would have been almost $1 million lower. So you would have made $1 million more by concentrating and doing the research on only 3 good companies. Now, I'm not a baseball fan, so I'm really not good at explaining the baseball metrics that Peter Lynch uses. But he kind of compares when to invest in a company like playing a baseball game. You need to know at what point of the game you're entering. Where is the company in that game? Is the game just beginning? Is the game almost over? Where are we? That's what he means, that you have to keep an eye on the company and the fundamentals and know what's happening, what's the company doing. So you need to know where on the curve the company is.
10 years after Walmart went public, 10 years after it went public. 10 years after it went public. It's a 25-year-old company now.
Right.
You could have bought the stock and made 50 times your money on it. 50 times.
This is, if you bought it 10 years after
it was public already.
Yeah.
It already gone up 5-fold. So you could have made 250-fold. But I'm saying, let's say you were in a town, they came into it and they said, boy, these prices are great, they're doing terrific, I like the bargains, and you checked it out. You spent a little bit of work on it.
Yeah.
I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's only 10% of the country, they're not even saturated there, why can't they go to the rest of the country?
To use Peter Lynch's examples, that you can actually get in when it's already good, and it can still do exceptionally well. It all depends on the company. You need to learn how to judge the curve. Where is the business? Where is it going? How much does it have left? Ooh, getting to the biggest mistakes. And actually, I think these are the biggest mistakes that all investors make. At least Peter Lynch has made the same argument, saying that these are his biggest mistakes. And actually, I can only agree. I made the same mistakes several times over and over. Usually I put those mistakes into 3 categories. 1, getting in too early or too late. Yes, I know, timing the market and all that, but that's not the point. 2, getting out too early. Or 3, picking the wrong companies. Well, number 1, getting in too early or too late. I don't know about the too early part. It's only a question about how long your timeline is and what you can actually sustain to wait. Getting out too early. That's the worst and biggest mistake, and that's the one I made a lot of times. Getting in a company, I always have an exit strategy, a kind of a number where I know where it's going to go, or at least I think it's going to go. And sometimes when it hits that, I'm just going to sell no matter what. And then a little later, I realized that was not the top. So I was actually going out way too early. I like the phrase, let your winners ride. That's what you should do. You should always look at the story. Did the story change? Did anything change? Why would you sell now? How much left is there in the company? Picking the wrong companies. Well, this is actually not such a big problem for me, as I use a fairly amount of time of finding the companies. And then when I buy with conviction. I don't dollar cost average. I have a fixed amount. That's the at least I put in a stock to begin with. And that's usually around $10,000. So I know I have an okay size position to start with. And then I can add on when I get more money because, well, money doesn't grow on trees. And I don't like selling stocks. So what's the conclusion? Invest in what you know and understand. And if you don't, then educate yourself, research, look at profitability, and preferably no debt, or at least low debt. Good management with good plans, not just those talking heads you hear from some of the companies. And then please don't trade in and out of the stock, no matter what. It's a lot better to be fully invested than trading in and out. Remember, timing the market, almost impossible. And if you have a position, it will hurt you a lot if you try to sell it and try to get back in. Be flexible, look for what others don't, and let time work for you. Remember, all of the time, keep an eye on the company. Has anything changed, or is it just some factors that the company is not responsible for? That's it for this time. I hope you enjoyed the video, or at least learned a little. And I'll see you in the next one. Bye.
I mean, the stock market's a very good place to be, but I can toss a coin now. Is it going to be lower 2 years from now? Higher? I don't know. More people lost money waiting for corrections and anticipating corrections than the actual corrections. Well, you ought to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do you do if it goes down 20? Am I going to sell? Am I going to get out? If that's your answer, you should be reducing it today. I never looked at the economy. I want to find out, the only thing I would look at what's happening right now. You know, what's going to happen a year from now? What's going to happen to interest rates? I'd love to get next year's Wall Street Journal. I'd pay an extra $1 for it. That'd be very helpful. I don't know what's going to happen in the future, but I want to find right now.